Good morning, everyone. This is Mortgage Pros 411. I'm Audrey Boissonou, and I'm here with Kevin Casey. Boy, say that three
Think
times
about
fast.
that. Yeah, you
And
had to think
today,
about that.
today, hang on. It's been a while since we had her because I needed a long time to practice her name. We're here with Maureen McInerney.
Wait. Why did
Hi.
you have to practice that? You've been
Okay,
practicing.
just stop, Irish boy. Okay, that's enough out of you. So last week it was St. Patrick's Day, and we had two out of three of us were Irish, and we were in the green with mortgage-backed securities. The rates were better, and today not the case. So what's up, you two? I blame both of you.
Oh,
Okay.
okay.
Maureen is with Inner Island Condo Reviews. She is an expert when it comes to what is going on. And gosh, we have had some changes. So we will get to those in a moment. Just quickly, it's a light week as far as economic news goes. We have mortgage applications tomorrow. We have jobless claims on Thursday, but it's all about the war and all about oil prices. So, yeah, so no way to tell what the hell's going to happen next. So we got that going for us. Um, Yeah, there you go. Okay. We had ADP's weekly report that came out, showed that we had an average of 10,000 job creations this week, or the week ending March 7th. That would put us on target for about 40,000 for the month. We know that BLS showed 92,000 job losses, and their next report is April 3rd. But I thought it was interesting when I was listening to Jerome Powell's comments after the Fed meeting last week, and they seem unconcerned about employment. And I got the impression from him that they feel like the fact that we're not having a lot of job increases is offset by the immigration change, policy changes, et cetera, that have lowered the number of people who need jobs. And they're really focused on the unemployment rate more than, the job losses. Again, this was my impression, but we'll see. So
Yeah. You know why he's not concerned about job losses?
because they feel
Because he's
like
got one.
not for long. Well, I guess he could
Well,
for a
yeah,
while,
he's going to
but
retire and go off into the sunset. He's fine.
we'll see. He actually did comment on when will he be leaving, and I guess there is some precedence, and it happened with him as far as precedent, not precedents, precedent as far as what happens if the next Fed chair is not confirmed by by the time that they're supposed to switch. At that point, he'd stay on as a temporary and as chair, and then he will be staying on the Fed um, until the what are we calling it? The accusations against him are put to bed finally once and for all. So that was something. They also raised their inflation forecast from 2.5 to 2.7 core PCE, and their dot plot is showing one interest rate cut this year, but we know how that goes. Anything could happen. So that means basically nothing at this point. We also saw new home sales in January. Let's just call it tanked. They tanked. So it showed an annual pace of 587,000 units, down 18% month over month, down 11% year over year. And while the media made a big hubbubaloo, is that a word?
I think you're mixing two terms, but okay.
I think I am too, actually. Um, I swear I'm sober. I swear.
But
Um,
isn't Hella, wait, isn't Hella a Bay Area slang word? Hella? And then
it
bull
wasn't,
plus
no,
like
Hella
that?
is Southern
Holla.
California, and we are
Yes.
decidedly
No, it's
not
definitely
Southern
Oakland.
California.
No, yeah, that's an OC thing.
That's an OC thing. Good grief. You're from San Francisco. I'm from Walnut Creek. You should know this. Okay. So I just wanted to as MBS Highway pointed out, so I'm going to piggyback on that. So even though 18% month over month sounds like a disaster, a few months ago, that would be October, November, we were up 17% month over month, and it wasn't a big, humongous headline. So again, the numbers go up, the numbers go down. We need to look at the trajectory, um, which direction are they going in general, up or down? Okay, I love it that the chat is silent until we start discussing Hilla. So
Okay.
I have two votes here for it is definitely a Bay Area slang thing, which
Yeah, no, I've
again,
got three saying it's
Yeah, but did it start in the Bay Area and go down or go down
yes.
and go up?
Started out of Started
Because
out of
Gwen
Oakland.
Stefani, no doubt, they are from Orange County, and that's where I know it from. So I don't know if it went up to down or down to up, but
Well, you're
Or
from
even
Orange
went
County,
down
right?
I
down there.
am.
Okay, I'm from Walnut Creek, and that was now I will say my kids said, "Oh, there it is. It's the oh,
All
she's
right, we'll get
okay."
it to the Bay Area.
Robin's saying it's a Bay Area thing from the early 2000s, and I will say that my oldest child graduated from high school in 2005, and there was definitely hella going along there. But I always gave it credit for Southern California, to Southern California. Oh
No,
my
no,
God.
no.
Okay, either we don't have anybody listening from Southern California today, which I highly doubt, or I
It's
mean it's
correct.
all East Bay. Yeah, or it's correct,
Yeah.
exactly.
Like,
Oh
no doubt
my
has a song called, yeah, hella good. Okay.
Oh God. Oh my God. It's so funny. The chat is just like brrrr with everybody chiming in, but it's 100% East Bay Area.
Okay.
Oh, that's really funny, Kevin. Um, okay. Where do we go from there?
Somebody's in SoCal representing.
Oh, there we go. Oh,
There
okay.
we go.
Yes,
Oh,
no
okay.
doubt.
See,
That's
okay.
who I'm
So someone
giving.
said I'm in Orange
Yes,
County and I remember it from no doubt.
absolutely. Hella good. Yes, yes.
Okay, yeah. All right. Well, okay,
Okay.
and definitely have Southern California people in here too. All right, if you're from the rest of the country, chime in because we'd like to know where you got it. So
They don't even they never heard it in the rest of the country.
that's impossible. I mean, they did watch TV, right? So, all right. There was also a little news last week about the banks and the capital requirement, and I think we talked about that before, but there is some hope that maybe the capital requirements for banks will decrease and or they'll stop counting mortgage bonds in their numbers and then they'll be able to invest more. So I just
Or
did
and
a
that's
really
what
crap job of explaining that, but we've explained it before and we'll have an economist on soon that will
yeah, because I don't
take us for a
understand
deeper
if
dive in
that's
there.
good or bad for mortgage brokers.
Well,
Because
that's a great
good,
question.
more banks doing loans. Bad if they're keeping it to themselves like they currently have been.
So
Well,
that's not what it is.
yeah,
It's not a function of them doing more loans, although in theory, I totally get your point. Um, well, not in theory, I get your point. I get your point, but in theory, they're not connected. So we'll see. Okay. So
we need a Basel expert.
a basil expert. So
Yes,
either
you
I'm
get
going to
two.
find an economist or a chef. It's one of
Yeah,
those.
that's well, it could be a farmer too.
Really? A
Well,
basil?
Basil
I'm none of
farmer.
those things, so don't
A
look at
basil
me.
farmer.
Okay. Well, yeah, you're off the hook, Maureen. We won't there you go. And then Cotality came out with their in January with their January numbers for single family rents and new rents were up 1.3% year over year, which is down from I think the high was 14% year over year a couple of years ago. And so those have been helping the inflation numbers, which by the way, need some help because PPI came out totally not great. We expected both core and headline to be up 3/10, and core or headline was up 7/10, and core was up a half. And the headline went from 2.9% to 3.4%. Core went from 3.5% to 3.9%. Not good. And that's wholesale inflation, which means I mean, that means there's probably price increases that haven't made it to the consumer yet. So, ugh. Ugh. All right. So, Maureen, I know that you're enjoying sitting there looking lovely, absolutely
Oh,
lovely. But let's talk a little bit about, I don't know, condos, shall we?
yes. So we had great news last week from Fannie and Freddie. I believe it was Wednesday afternoon, after a lot of rumors about them coming out with some new guidelines. They did, in fact, and pretty much across the board, it was like dancing in the streets. Good news.
Great.
So hooray, because condos have felt nothing but more difficult, more challenging, more hoops to jump through since the Surfside collapse, the high-rise condo in the catastrophic collapse in Florida. So I will just kind of briefly go over this great news. One of the best things that Fannie and Freddie did was recognize the reality of the insurance world versus what they were previously requiring. So while technically you're still wanting to see master insurance policies that are 100% replacement cost, they have given us a huge win in accepting actual cash value on roofs. Because in places like, California, Florida, a lot of the coastal places where you get, um, you have fire damage, hurricane damage, hail, all of these things. A lot of HOAs could either not get replacement cost coverage, full stop, irrespective of what it cost, or it was prohibitively expensive.
Mhm.
So all they could get was actual cash value on their roofs. This was a reason that countless projects had become ineligible. They were doing everything else right, but because they couldn't get replacement cost on the roofs of their buildings, that made the project ineligible. That has gone away effective immediately, which is huge. It's fantastic. Another wonderful win for condos is previously an endorsement on master policies called inflation guard was required, meaning that automatically every year to kind of track with inflation, the coverage amount of the property policy would go up, but 2%, 3%, 4%, whatever. They have eliminated that requirement, which is fantastic
Wow.
because, again, that alone was sometimes a reason a project was ineligible, which was maddening because they were doing everything right. And, they just didn't happen to have that endorsement, couldn't get it, what have you. So those things alone are fantastic. This may not be as relevant for this group, but it's a huge deal. New projects in the state of Florida no longer need a PERS approval, which is huge because that was, usually about $8,000, a ton of time, a lot of work. So now in every state, a new condo project can be certified by either the lender or someone like us, who lenders
Wow.
use and rely on for all of that condo expertise to review the legal documents, make sure all the mortgagee provisions are there. There's still a lot of work in ensuring that a new project, especially if it's phased, meets all of the requirements. But at least now that's an option. And that, of course, is something that we specialize in doing, as well as parsing through all of the insurance requirements that are still on the table. Did you have a question, Audrey? You look like you were going to say something. No. Okay. So that is fantastic. The other thing that you want to be looking at if you happen to get a certificate of insurance for a condo project is to make sure that they don't have per unit deductibles. Okay. So that's what you're looking for, per unit deductibles that exceed $50,000 per unit. So there's kind of two caps here. The agencies will no longer, it doesn't matter what it's for, the geographically peril exception that we had before was taken away, which it just kind of streamlines things. If you see a per unit deductible that's more than $50,000, you are dead in the water. Okay. Not a lot of black and white for condos, but that is one of them. Alternatively, if say it's a $10,000 per unit deductible, if in the aggregate that equates to 5% or more of the coverage amount, which we call the total insured value, that is also not acceptable. So definitely keep a sharp eye out for per unit deductibles because there is no workaround for them if you exceed the 50,000 or the 5%. Um, and I know it's good to know those things early on, and you want to tell your realtors as well, because getting the COI should be something that you should be able to do quite early on. The other thing that remains, and unfortunately we did not get any additional clarification, is the requirements with respect to critical repairs and deferred maintenance.
Mm.
So, absolutely also be very aware of whether or not there are ongoing construction projects, repair projects. Does this project have scaffolding up in it? These kinds of things. And of course, as always, the SB 326 in California. So if you have a project that's required to have the SB 326, which they extended the deadline, I think, 3 times, but now was January 1 of this year. If they have a report and they have a lot of, sort of yellow, orange, definitely red, elevated exterior elements, you're going to have a problem because that's a fundamental structural issue. If there's just a couple that are maybe yellow or purple, or it depends on how they're doing it, you might be okay. Because the guidelines say if it's just one or a few, then it's all right. But if you get your hands on an SB 326 and you go to the back to the index and it shows a whole bunch of yellow, maybe orange, and definitely red, you're going to have to sift through that very carefully. It's okay if they've been repaired, but if they're not, that gets much more challenging. And also do remember that any mechanical or structural reports that have been done in the prior 36 months, a copy must be given to the lender to review. There's no like, well, we don't give that out. Well, then you're going to be stuck. So,
I love that answer. Well, we don't answer your questions. Well, then,
yeah. Oh, we get that all the time. And
yeah.
especially with the deferred maintenance and the critical repairs, or you'll get did they increase? Okay, I'll get to the reserve requirement in just a second. Is it Lilia? I don't know.
Yeah.
Sorry if I mispronounced that.
Yep.
So the answer is yes, they did increase it, but I will get to that. So just keep an eye out for those kinds of things, and saying we won't give you that report, you're going to be stuck. Or if they refuse to answer the deferred maintenance questions. At Inter Island, we have worked very hard to find all kinds of different ways to finesse getting those answers, because we have to have them. You know, is there water intrusion? Have they failed an inspection? And you will often see that verbiage that says, you know, we're not licensed engineers and we're not licensed architects. But honestly, guys, those are usually yes or no questions. Like, are you aware of water intrusion? Are you aware of whether or not they failed a jurisdictional inspection? You don't have to be a professional to know that. That is a yes or no question. Or saying we encourage lenders to go check. That's totally unrealistic. So that continues to be sort of the Grand Canyon of gray areas. So again, just be very, very aware of SB 326, work going on, projects. If you see, you know, peeling paint and a roof that looks questionable, those kinds of things. As with respect to reserves, there are two really big things, and these kind of go hand in hand. As of July and August, respectively, the two agencies have different dates. There will no longer be a limited review. They have abolished them. Inter Island will continue to do those until the respective cutoff dates. But folks, that means that in condo projects where you could previously get by because your LTV was low enough and you had somebody putting down 20 or 30%, that alternative route will no longer be available. The agencies figured out, okay, maybe this is a strong borrower, but we're still lending into projects that aren't doing what they need to do to be financially stable and responsible. Because that the limited was the out, right? It was,
Yeah,
if you
that was
put
my
down,
last close.
yep,
Condo.
if you put down a big enough chunk of money,
Uh-huh.
we can turn a blind eye to how underfunded you are.
Yeah.
So that goes away. So that's a huge, huge thing. So don't think in the back of your mind, okay, well, I've got somebody who's going to put 30% down on a primary home. I don't have to worry about this. Yes, you do. They want to see all of these condo projects doing the right thing financially. And what they have done is, as of January 1, 2027, the requirement is that 15% of the annual assessment income has to be allocated to reserve funding. So if you just take the normal HOA assessment, you don't have to look at special assessment income, or maybe if they have cell tower income or things like that, other sources of permissible income. But you just look at your HOA annual assessment income, you're going to need to see a 15% allocation as of next January 4th. I think technically it is. So the elimination of the limited and the 15%, you know, and what's hard is that I don't think a lot of HOAs get this information. You know, it's not given to them, or, you know, then they don't have great management companies who are keeping up with this. So the more that lenders are aware and can kind of distribute this knowledge and information, the better it will be, and less unexpected surprises there will be.
You know
So
how they find out?
Us.
It's
yeah,
when the loan gets turned
right,
down,
when it blows up.
and
Yeah,
the
right.
buyer,
And
the seller
yeah,
is like, "Hey, I can't get a borrower to buy my
yeah,
house, my condo," and then it's too late, and then it's like
yes,
takes them a year to fix that.
yeah.
And,
And then
More than a year.
the sellers and the buyers are both stuck in a situation where, conventional financing isn't an option, and that's hugely detrimental, obviously. But there are ways of backing certain things out of budgets, and that's something we are also experts in, and knowing what can be removed from that equation and what can't. But yeah, so the reserve increase, the removal of the limited review, those are, two of maybe the more challenging changes. But again, huge wins with, the ACV, the removal of inflation guard. Um, and it's just really reassuring to see that the agencies have reflected what the reality of the world is, especially in the insurance space.
I I just want to remind people that I'm sure they know. Most of us know that realtors tell their sellers that the approvals with it on the HOA is a buyer problem. And so they really do continue to put it on us, although we have actually spoken at realtor associations and we would encourage you to do the same. These guys don't seem to get it until they have a deal that blows up in their face. I actually had one realtor tell me that none of this is a problem in Southern California. And I'm
oh
like,
yeah, I remember that.
oh, for God's sake, okay.
Oh, if,
Um,
if I had $5 for every time, or and guys, don't fall for this one. Well, other people are closing loans in this project. It is critical that you remember that just because another lender has closed a loan in a project, that by no means indicates that the project is actually eligible. Not every loan is audited. That's the truth. Closing a loan means nothing with respect to eligibility, right?
right.
So lots of lenders roll the dice and get away with it. Absolutely. And that's also why some lenders disappear overnight and then show up the next day as someone else. So if a realtor says, well, three other people have closed a loan, and someone like Inter Island has reviewed it and said this is the problem, that's the actual state of play. You can roll the dice all the time and probably get away with it for a while.
Well, for a
So
while,
remember, that doesn't mean just because it's closed as a Fannie loan or a Freddie loan doesn't mean that Fannie or Freddie have looked at it and blessed it. It doesn't mean that at all.
I used to really think that this was something that we were trying to figure out how to work around. And now I look at it as a gift to the borrowers who are buying into these associations because it really does vet these associations. Our process does, to the point where at least if they decide to go ahead with their purchase, which is fine if they're cool with the possibility of certain things happening or being an
Yeah,
issue. But
yeah,
for the average borrower who cannot take a hit of some monster special assessment that comes out of
yes.
nowhere, or one of my clients who had gotten a perfectly clean bill of health on their HOA when they bought into the association, then
Mhm.
found out it was a complete and total disaster. Their association dues went from 400 or 450 a month to 1400 a month. They had like $100,000 assessment, and they were so ineligible, it wasn't even funny. And also remember that you can be on the Fannie Nice list and be approved. And so maybe those three loans closed, and then Fannie Mae one night figured out that there was an
Found
issue,
out.
and
Yep,
poof, you're off that list the next
yep,
day and you're dead in the water. So,
yes.
again, this idea that you can game the system is not good for your borrowers, first of all.
No.
And secondly, it can really bite you in the tail. So, we've talked about keeping contingencies on a purchase contract all the way through the close of escrow, things like that. We've always promoted get 12 months of the meeting minutes from the association meetings so that you can see what are they talking about. Is there something coming? Are the roofs funky? Is the siding needing to be replaced? All of that. So,
And if those meeting minutes are really thin, also be suspicious
uh,
because we sometimes ask for meeting minutes in order to do the due diligence for the deferred maintenance, and they are so useless
mm,
that it's very concerning. And they'll just say, we discussed this in the,
yep,
in the meeting, in the board meeting before, and it just says we discussed maintenance issues. All of your spidey senses should be up. And you're right, Audrey, because we've actually had LOs come back to us and say, this was an older person on a fixed income.
yep,
And even though they loved this unit, they absolutely dodged a bullet because these
yes,
huge special assessments that are
Yep,
inevitable because
yep.
all buildings are going to need maintenance. And you're touting that you have low monthly HOA dues, but it's because you're not doing the things you need to do. And
yep,
so keeping your borrowers out of badly managed projects, you're really doing them a favor. I understand you don't get your paycheck, I know, but hopefully, they'll find another one and then realize when they calm down a little bit that you have spared them untold agony because
yep,
like you said, when it goes sideways, then you are stuck. You can't
yep,
refi, you can't sell, you can't do anything.
I,
So
I had I had a case
yeah,
where I had someone who was buying a house or a condo, and it did not have the insurance did not cover water damage.
yeah,
So that was it. Like, okay, this is not going to fly. So
yeah,
uh, I did find a lender that was willing to do it. The borrower had to put 25% down, and they had the money, which was good. They had reserves, lots of reserves.
yeah,
Um, and the property was located exactly where she wanted to live. Like it was so perfectly located for her. And so I went over the pros and cons with her. I said, listen, if it was me personally, I wouldn't buy in this condo. This
right,
this is going to be a problem. There's no water dam, no water coverage. If something happens, you're on the hook for it. And but the offset to that is you have the reserves. You would be able to afford it.
right,
So
right,
maybe it makes sense for you to go ahead because
right,
you are definitely buying a house, a condo that 2 years ago was selling for $800,000 and today is selling for under $600,000. So you're getting a $200,000 off the top discount just because
yeah,
of the situation they're in. So
yeah,
maybe this is your opportunity to buy this,
right,
and maybe it's a time to walk away from this. She
right.
decided to move ahead and buy the place. But I
Well, and
made
the point is though, that's a fully informed decision.
exactly.
exactly.
I made
And
sure
that
I documented the hell out of that, though. I can
Yes.
tell you that.
And that is not generally like if you take the sort of 600 plus $1,000 condos, you're talking, I mean, obviously in California, everything is expensive, but it's still relative, right? So, but it's still about making a fully informed decision about the risk that you're taking. And yes, you get your HO3 policy and it can have loss assessment coverage, which means that if a special assessment is levied, you actually have insurance to help you pay that. But again, it's all information is power, knowledge is power, and you have to know what you're getting into because the other thing we hear a lot is, well, it's not my building that's impacted.
Right,
This is a common interest ownership. You rise and fall together. So the fact that the other building has the foundation problems, guess what? You're going to help pay for that too.
Yeah.
So that's it's the good and the bad of owning
The
condos.
nice thing about that particular deal was that because I insisted that the real estate agent put in a clause that the condo had to be approved and all the way up to the close, that they would not remove the condo condition from the
Mhm.
deal. Saved the deal for the broker because it ended up, in the end, the initial lender could not do it. And the broker personally called me up and thanked me for looking out for him. And because of that, he's actually asked me to do presentations at his office and
Mhm.
referred me to two other real estate agents deals that they were having problems with. So it's like, yeah, you think
Yeah.
you might be saying no to a deal, but you end up getting more in the end.
Right, right. And again, I wanted to go back, Audrey, you made another point. If if you find out that a project is Fannie Mae approved in their condo project manager database, which is CPM, that is not the golden ticket, get out of jail card you think it is. That approval could have been done a year, 2 years prior. They now rebound their insurance coverage at least twice. They could have been hit by a wildfire. That is not the sort of safe haven that you think it might be. Limited reviews go away in July, I think for Fannie, and August for Freddie, or the other way around. I don't have that right in front of me, but you still have a few more months for the limiteds. But just remember, if for some reason or the realtor knows and says, well, this is Fannie Mae approved, we don't have to look at anything. You can take that risk because technically, if the project is Fannie Mae approved on the date the loan closes, they do have to buy it. But I will tell you that I have seen numerous occasions where we pulled CPM up when we started a project review, and in the intervening weeks, it became unavailable. So it died right there. So there's again no guarantee that it will even stay Fannie Mae approved in the window of your loan processing. So
There's a comment here that someone closed a loan in a project in early November. Someone tried to close another loan in later November and it was gone. So, and also there is a page where all of this is written down that we are going to make available to everyone if you'd like it, that Maureen and her company put together, which is really helpful. So, and if you would like to find Maureen, you can go to condoreviews.com. Am I right on that,
that's
Maureen?
exactly right. It's very
Oh,
easy.
imagine.
Well, condo
So,
review.
yeah, so that this is something that is available for you for sure.
Right.
And
And it's on our LinkedIn. If you go to LinkedIn to Inter Island Condo Reviews, the summary is right there for you. And you're welcome to take that and use it. And we like to help the industry by making sure people know what is going on and understanding it. So that's also on our LinkedIn page.
yeah, so I also want to make a remind everyone that the California Association of Mortgage Professionals has been in Sacramento actually working to get the HOAs to have to comply with the law, which is they're supposed to be supplying these documents that we need for these reviews timely, and I believe that the time that they're allowed is 10 days, and also addressing the egregious, to put it mildly, fees that are being charged by some of these companies
Oh,
to
that's
provide the
unconscionable.
documents.
Yeah. That we need lobbying in that. Somebody had asked me a question that I haven't
We
gotten
are
to,
doing that. I mean,
but
Camp is doing that. We were just in Sacramento this
oh,
week, and
it's
the
unconscionable.
it is. Yeah. And then a lot, like they were talking about situations where they were charged a rush fee for documents. And again, they're required to get them to you within 10 days, and they charged a rush fee and delivered them in 9. I mean, come on. So,
And a lot of times don't even answer all of the questions. Then they
right.
give you the non-answers to the deferred maintenance, and you've paid $1,000 for the documents and
Yeah. So
weren't even getting
actually,
the information.
that's a really, really good point. Actually, that should be added to what they are campaigning for. So, God bless Jason Bellevue, who's the current camp president, who will be listening to this if he isn't already, and they can add that because if they're charging these fees, and again, not little fees, and they're not even answering the questions, they shouldn't be entitled to the fees.
No,
That should be part of
I
it.
couldn't agree more. It is absolutely, and in any other industry, you could not get away with treating a consumer that way for
Yep.
charging them for a service and then essentially not delivering it.
So we
Class
have a
action, class action right there.
God, that's great. That's what this industry needs. More suggestions for class action lawsuits. Good job, because we're going to get roped
No,
into that.
no, let's just get them to do the right thing.
Yeah, how about that? Good God. Okay, I'm glad he's so amused with himself. You keep laughing, and I'm going to talk about Marty's comment, which is, why do you think that NAM is lobbying against these new requirements versus lobbying against HOA management companies that are hindering the necessary repairs, delays in HOA reserve studies, and the fees that HOA management companies charge for release of the information? Marty says NAM should be working to increase homeownership versus being against homeowners' health and safety issues that the agencies are suggesting to protect our homeowners. The management companies have their own profit agenda, and their fees to obtain timely information for homebuyers is out of control. Okay. So the point is, and I get it. I get where they're coming from initially, like a couple of years ago, which is, I mean, I've spent a pretty decent chunk of my career where we had this idea where, oh my God, we have these guidelines and we somehow have to, how are we going to deal with them? Can we get a limited review? And now it has been completely turned on its head, I believe, because there are such health, safety, and financial implications to bypassing these. And I've actually said to borrowers who were talking about buying condos, and one of them in particular, they were going to pay cash, and they're the ones with the realtor who thinks that this isn't a problem in Southern California. And I said, the current routine that a lender is going to put the HOA through, it actually protects you. I mean, it might be worth it to go through that process.
I've had two big stories. Currently, one right now where the seller trying to hide that there's a default on a solar panel, and they're trying to carry that over to the new buyer. And the other one was a condo that was the building was condemned, the entire building, like 8-story building, whole building's condemned, and but they were selling individual condos for $50,000 cash only. And had someone come to me and goes, "Hey, this is a great deal. It's cash only, but what do you think?" I'm like, well, is it really a $200,000-$300,000 condo that's being sold for 50? And he goes, yeah.
All the warning bells should go off.
All the
I mean,
warning bells went off of me. And I go, there's a reason why it's cash only. They don't want the lender review.
Yeah.
I've said this twice now. They don't want the lender review. And sure enough, that's exactly what they didn't want when they wanted cash only. And in the condo, the condemned one, the building was condemned. They did not disclose that to him. Oh yeah, you can buy this condo unit for $50,000. Oh, we're not going to mention the fact that it's condemned. You're
yeah,
just
if
buying
it seems too good to be true, it is.
Yeah.
I was talking to a new buyer that came to me yesterday, and God bless her, by the way, just as a side note, she's like 30 years old, has been living at home with her parents and working, and saved $100,000 to buy a place. Oh my God. It was the best conversation. And she was so smart, and she wants to buy a condo. And so, of course, the second someone says, I want to buy a condo, I've got the bells going off in my head. And this kid had absolutely done she had been studying
Oh,
this. And so it was really funny because I said, there is a process. I mean, we're going to qualify you and your credit and your income, and obviously the property as a property, but we're also going to really vet the homeowners association. And she said, she goes, there is an association in Walnut Creek, and she named it. And I said, I will not allow you to buy in there. Do you understand? And it's this association that I'm not going to say, so it won't be posted on.
I know which one you're talking
I
about.
know you would. I don't. So anyway, this is an association that has had terrible management practices for the entirety of my career. And because they're literally in my yard, not just my backyard, they have never met a bill that they wanted to pay without fighting about it. They have never done anything the right way. And so their condos are $300,000 in a market where you've got $1.5 million condos, but their homeowners dues are $1,000, or they'll have a $60,000 assessment. And I mean,
Mhm.
and anyway, but God, she knew. She knew about this. And I'm like, oh, you're so smart. Anyway, I gotta love these.
Only all borrowers were that savvy.
I'm like, yes, I know. But again, I'm like, no, 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 no. And we need to do that for our people. We need to be advocates for them and help them
Mhm.
understand. And there are people that go into that association and pay cash, and they rent them out and knock yourself out, right? If you've got the money to do that, that's fine. But for the average borrower, that is not a good plan.
No,
And
no.
and we definitely need to be looking out for them. So again, this is not a time to try to get around these guidelines. It's a time now, again, to Kevin's point, and the point is, if somebody is fully informed and they're making the decision, great. And then also we have the borrowers who already own in these associations. Then what do you do? So we're dealing with these questions every day, and again, information, education, making sure that they are understanding how it all works. So
Yeah.
okay, so there is something called a waived review. Can you
Ha
walk us
ha
through what
ha.
that is, and how
Yeah.
often do they have it happen, and can we get one on a refi? So,
Okay, so that is the worst misnomer ever. It is not actually waived. Waived to me means you do not have to do it.
right.
Terrible misnomer. So I'm actually glad you brought that up though, because that was one more thing I wanted to throw in. Previously, a waived review applied to 2 to 4 unit projects and site condos, so fully detached condominiums.
Hmm.
and also planned unit development. So not condominiums, but PUDs, which people normally refer to as a townhome or a townhouse. That is
Right.
not a legal term, that is an architectural term, but it's the term that most people use when they're referring to a PUD. So that is where you actually own the dirt underneath your unit and you are responsible for the entire exterior, including the roof normally. But the waived unit has now been expanded from 2 to 10 units. So that's also a great win.
Yeah.
Because again, guys, you have to at least have 2 units to be a condo. There's no such thing as a 1 unit condo. So 2 to 10 now falls into the waived, not really waived review. And that means that, but the insurance still has to meet the guidelines and you still have to um, verify that there's no deferred maintenance or critical repairs. That's basically what it comes down to.
So
So
what's waived?
what's that?
What don't you have to do then?
The financials. That is a situation where you could have what we think of sort of as a limited review. Because I would say that instead of saying waived, that's the new limited review. Because you don't need a balance sheet, you don't have to verify the now, 10% or in the future, the 15% reserve allocation. So if you have a small project, 10 units or less, then you don't have to worry about the reserves, the financials. You're really just going to look at the insurance and the physical and, the structural and mechanical aspects of the project. So not really, really wave, but, less hoops to jump through for sure. But again, those are not that common projects that small, but obviously they do exist. So,
Yeah, they do exist.
yeah.
It's probably a good time to remind people that you really do need to look at a preliminary title report to determine whether something is a condo or not.
Yes.
Because again, we don't really have that here, where
I've
you
had
have
that.
condos that are separate units, like there's no connection in the walls, but
Yeah.
they certainly exist in other parts of the country. And also, we have a lot of realtors who know condos are a pain in the wazooski, and they will put townhouse on their listing. And either they are doing it on purpose or they are just clueless. I don't know which, or maybe both
Right,
sometimes.
vice versa. Yeah, sometimes.
Yeah.
How many times have you had someone who's buying a PUD and they'll say it's a condo, and you start going into condo process and wait, this is a PUD,
Yeah,
like
Uh, yeah.
get
And
the
the
prelim.
best thing to do is to look at the title and see, if it has been submitted and it shows like a condominium or if it, because usually you'll see a condominium declaration or master deed, whereas with a PUD, you're going to see CCNRs,
Yeah, it's really
conditions
clear
coming
on
to
the title
attention.
report. Well, okay, let me just back up. It's
Yeah, and
usually
just remember
really
a
clear,
townhome, a townhouse
usually.
is not, yeah, that's not a legal word. That's, you've got to figure out condo or PUD.
Exactly. And you cannot eyeball it. You got to go
No, you can't
title
tell by
report.
looking.
I can't say it enough. Title report, title report, title report. Okay. So, okay, let's go back to the reserve requirements. Somebody's
Yeah,
asking that
saw that.
we take a dive into that a little
Okay.
further.
So if you look, you get the condo's approved budget. It can't be proposed. It has to have been voted on and approved for either that calendar year or that fiscal year. Usually at the top, it'll have the income. So let's say it's $100,000. That's their HOA assessment income. There needs to be a line item on that budget that says reserves, and it needs to be 10%, give or take. Again, there's some wiggle room, but that's where our expertise comes in as far as those calculations. A line item that is 10% of that total annual income number. So it would, in that case, you'd want to see about $10,000. Um, if it's, if you do that math and it's 9.6%, there's probably something that can be backed out to get you there. But that's what it is. And guys, remember, it has to be allocated to their reserve funds. So that means it is earmarked, it is set aside, it is not commingled, and it is there for CapEx projects. So maintenance, improvement. It is not something that can be like, oh, well, we want to have a really big Christmas party this year, and they can slide that money out. It's not that. The
you know
agency
that's going to
wants,
happen.
yeah, well, that's neither here. We always joke that budgets are aspirational. Like I know mine is for my family, but but that needs to be specifically set aside. So sometimes it'll say savings or things like that. And if we get a letter of explanation that says, no, that's our reserve account and that's the money that we use exclusively for maintenance and repairs, that should be fine. But you really want to see it as reserves, ideally. And again, not money that can be slid
Yeah.
into other categories, but that, hopefully they're maintaining and that it's built upon each year. And also remember that if they give you a balance sheet and they say, well, we have X number of dollars in the bank, that's not what we're talking about. The budget every single year needs to show that an additional 10% is going into the reserves, unless they have a reserve study that shows they're fully funded. In probably doing near 20,000 condo project reviews personally, our company has done over 100,000.
No.
I've seen that 3 or 4 times. So that, like, well, we have this reserve study. If you're following it, if they're following it and it says you only need 8% and they're doing 8%, you're good.
Huh.
But again, that's not very common.
How about when they have, let's say they have the 15% set aside, right? But now
Yeah.
somebody needs to do a project on the buildings, replace siding or something like that. And they're going to dig into that reserve.
Yeah. Which is
Now they're
why
going to,
it's there.
right, well, that's what's there, but now they're going to have less than the required reserves.
No, 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 no. See, you're conflating those two things. The budget has to show, which I'm glad because that happens all the time. The budget has to show that 10% of that year's income is allocated to
It's
reserves.
allocated
Of
reserves.
course, of course, they're going to deplete that account. That's why you build it up, you take it out, you do the repairs. So we're not looking at the balance in the account. We're
Got it.
looking at the allocation because, of course, that number is going to fluctuate, right? And it's meant to. You want them to use it to make the repairs. So, but again, a lot of times they'll have like a 5% allocation on the budget and say, well, we have $1 million. I'm like, that's great, but you don't have a reserve study that says you only need 5%. So the fact that you have $1 million over here isn't going to meet this requirement. They're not
That was a
interchangeable.
that was a good question, Kevin, because I think there's a lot of
Yeah,
confusion around that.
a lot.
So, okay, so we have a couple
The,
comments. And so
the
to
next
be
one
clear,
part. Yeah.
to be clear, you had said in we were talking, you said 10%, but now it's going to be 15%. So,
Yes. So
right.
the 15% starts January 4th of 2027
Okay.
because this just came out. They're not going to, that would be ridiculously unfair.
Well, that doesn't
It's
mean they wouldn't do it, Maureen.
fair enough, but even for them. So the agencies, it's 10% right now, but the 2027 budgets will be required to show the 15%. And we are looking at the the gross income, not net.
Okay.
So again, if they show that their HOA income, their assessment income is $100,000, that's the number we're looking at divided by whatever amount that they've set aside. And yeah, capital expenditures probably work. Somebody asked if it could be called that, and then maybe we'd just say just to clarify, this is what your reserves are. That's fine too. You can call it capex. We just want to make sure that that is not um, money that just kind of free floats, right? That can be
Right.
used for anything. It needs to be earmarked. Um,
Do
Hopefully I
you
got all of those. Okay,
do you
yeah.
have a sense of what a reserve study would cost?
That's a great question, and I don't think they're terribly expensive. And again, as far as your borrowers go, I would be a little bit apprehensive if they hadn't bothered to get one, at least within the past 3 years, because you really want someone to come in and we look at those. And what it will show is every major component in the project. So your roofs, your siding, your facade, asphalt, things like that. And they will tell you what the remaining useful life is. What the estimated useful life is, so a roof is like 30 years, and then they'll tell you how many years are remaining of anticipated useful life. So as a borrower or potential purchaser, I would want to know, hey, look, our roof only has about two more years left of useful life. or the boiler and or the HVAC, especially in a high-rise building, things like that. Because then you can read the writing on the wall and know that a special assessment is coming.
Hmm.
Because all of these things are inevitable. They're not bad, but everything wears out, right? So with the reserve study, that is the information that the HOA really needs to make sure they are preparing for the inevitable, as opposed to, okay, here's a $4.2 million assessment that you're going to pay for the next 20 years. And when you sell your unit, you have to pay it off, that kind of a thing.
Right.
So I don't think they're terribly expensive. I'm going to guess like in the neighborhood of maybe $1,000, $1,500, something like that. Don't hold me to that because I don't actually know, but and some states require them. Florida does now. You have to get a what's called a SERS. It's a structural reserve study that looks at your structural components and tells you again, this is how, there are years of remaining useful life, and this is what it's going to cost you. And they put in, they use actuarial data or what have you to account for inflation. So what your roof will cost you in 10 years, that kind of thing. But that's the information you need to plan appropriately.
Interesting. I'd be curious to see how they figure out what that, do they use which number do they use for future inflation? Do you use current numbers? Do you use the numbers from 3 years ago? Do you use the
Yeah,
number? I mean, good grief, that's
yeah,
like a minefield. Okay, so
yeah.
Jenny made the comment, we only have one condo project in our town, but there's an attached PUD that all realtors call condo, and they don't like it when I tell them it's not a condo. And I'm like, I don't know why you wouldn't be happy that that now it's not a condo, but anyway,
No,
that's
you really, it's easier if it's a PUD. That's a good
right,
thing.
totally easier. So yeah,
Yeah,
so someone needs to, I don't know. Well, I'm
yeah.
sure it's Jenny,
I,
so I'm sure
I
she has
know.
done what she could to educate them, but some
Oh,
people
she
can't
probably
be
slapped him
educated.
around.
What?
Probably slapped him around.
I have no comment on that. I would never. Okay,
And
so
you
yes,
do need reviews for a refi just as a purchase. There's no
oh,
difference.
she's saying that they think it makes them look bad because they didn't know. Well, I mean, come on.
Well,
You know,
they,
yeah. Oh, yeah, yeah. Our egos, people, our egos,
Oh,
right?
well,
Anyway,
I had that the other day where I was talking about the scams that we get, and it was a couple of realtors, and I go, listen, not all realtors, you know, give us the escrow information the day the deal goes into contract. And there's some, so we will get, there's these spams that are going out there right now, and here's your escrow documents. And you're like, well, maybe that deal went into contract and no one called me. And you're tempted to click on it, but then you're like, wait, I'll call and confirm. And they've all gotten a huff about, oh, well, realtors aren't that, they always do this. I'm like, you guys do it, but not all do.
right.
It's
Right.
funny how
It
they
would
get in their little huff, though.
it would be like us insisting that every single loan officer on the face of the earth does everything for the benefit of their borrower, which we know is
speaking of which, I'm going to
yeah.
divert here real
In
quick.
in
hang on,
any profession, that's not
wait.
true.
We've got to finish this with Maureen, Kevin.
Yes, go
We
ahead.
can't, yes. So we have another question. Will we need a condo review for a cash out refinance on a townhome condo?
Is it a PUD or is it a condo? Because if it's a
Yeah.
condo,
Exactly.
yes,
So
you do.
stop using the word townhome. It's not a legal
Yeah.
description. So condo.
If it's a purchase, if it's a cash out refi, if it's a limited cash out or a non-cash out, um, that is irrelevant. The project still has to be reviewed exactly the same.
I wish there was some provision for people who already owned these condos and
I know.
already have, I mean,
Yeah.
that's where I wish that, yeah, that would
There
be,
is there is a really obscure one that is like it's a high LTV refi, but nobody ever really that doesn't understand it or use it. But just generally speaking, yes, the
High
refi
LTV
would
or a
just
low LTV refi?
high.
Really?
Yes,
Huh.
which doesn't make any
No,
sense. Yeah,
a low LTV would make sense, but a high.
right, exactly. But
Kevin,
it's
put that on your list of things to figure out for us, would you?
yeah,
Um,
in the meaning
okay,
of life.
so a couple things I just wanted to note. So apparently there's a new ADU policy coming March 31st, which I'm going to take a dive into and see if we can address that. The appraisal changes that we did a very, very thorough, extensive show on a few months ago, those are happening right now. And the cutoff date for the old appraisals is new November 2nd, 2026. And the recommendation has been make sure that you are using new appraisals by September so they're able to get through the system and to the GSEs before that November 2nd, 2026 date. And also, there was a question about whether Fannie Freddie are trying to get rid of appraisers, and the answer from both of them was a resounding no. They really need appraisers. They understand their value, or they seem to, and they understand that they need their data becomes obsolete fairly quickly. So they need appraisers to continue to feed the beast, so to speak, and give them the data that they need to operate. So that is that. There is a Senate investigation into the pricing practices, and I just want to remind everyone that while they would like us to keep focused on the $100 charge for credit, they would like us to forget about the G fees and the LLPAs that they benefit from that are thousands and thousands and thousands of dollars, but it goes to them instead. Also, MBS or GSE buybacks have finally started going remember we talked about this a lot a while ago, how the GSEs were auditing all these files and had all these buyback requests, and it was a real problem. So it's eased in 2025, and the buyback claims had gone down, but it was still $2.1 billion in 2025. And I just want to remind everyone also that those costs get passed on to the consumer. If a lender can't sell a loan into the GSEs or wherever they intend it to the investor they intended, they have to sell it on the scratch and dent market for pennies on the dollar. And again, when we're talking about the cost to manufacture a loan, and they're often talking about LO comp being such a big problem, I would think that 2.1 billion dollars would be a fairly significant line item. So it can make or break a company. And it's something for us to be aware of. And our part that we need to be doing is making sure that we are manufacturing really good loans and that we are cooperating if something comes up and needs to be corrected, even after the loan closes. So a reminder just to remind your borrowers that this could happen and that everyone needs to cooperate. So, Kevin, do you want to tell them about the NMLS scam that's going around?
Yes, I did. I'm going to share my screen real quick.
Hurry up. We're almost
Okay.
done.
They should be on the screen now. And many of you, in fact, not all of you, should have gotten this email. And any of you who clicked, actually, I just want to find out if anyone knows anybody who actually clicked on this.
Don't make any disparaging comments
I'm
about
not.
anybody.
That's what I'm saying. I didn't say who was dumb enough to click on it. I said, does anybody know someone dumb
And there
enough?
it is. God.
But you will notice where the email came from. NMLS team at something.au. That's Australia or Austria, one of the two. I don't know. NMLS is not based in Austria or Australia. So that's your first sign that this is a phishing scam.
Don't
I
click
have a
on
feeling
things, people. Just don't click on
don't
things.
click on this stuff, but they just keep sending it to us. So they're obviously people are clicking on it, or they would stop doing it. So please don't click on it. Tell your friends they're fools if they have, and they're making the mortgage industry look bad if they are clicking on this stuff because we get
Well, they're just hurting themselves. That's what's
yeah,
happening.
I know, but and if you have clicked on it, you need to follow the actual NMLS notification that came out the day after saying you got to go change all your passwords now because you just gave away all your personal information to some scammers.
All right.
All
So
right,
on that bright note, just
that's right. Stop sharing and back at it.
Maureen, is there anything else that you'd like us to leave with today that would be helpful as far as our dealing with condos and the rules?
No, I put the summary up there, and just one last parting shot. The other thing you guys want to be very hyper aware of is whether or not there's pending litigation in a project. Pending litigation does not mean the project is not eligible. There are very specific specified exceptions, but just help your borrowers manage their expectations that if there's construction defect litigation, you
Mhm.
know, that could be a really big problem if all of those alleged defects haven't yet been corrected. So another thing just to kind of keep high up there on your list of things to be hyper aware of.
How about delinquencies? Are they still a big issue?
Yeah, so and especially with the removal of limited reviews, because that was another piece that we could sort of turn a blind eye to. Your cap of allowed delinquencies is going to be 15% of the total number of units. Now, here's a little tip maybe if you're really close, anybody can pay off anyone else's delinquency. So if that's the sticking point,
Wow.
and it doesn't matter what the dollar amount is. So if you're really close to that cutoff and there's somebody who's got $600, your borrower, your realtor, you, whatever, y'all may just want to chip in and pay that person's delinquency off to get you below that 15% threshold. But
Wow. I would have never thought of that.
they don't
That's
really care.
interesting.
There's no rules about that as long as it's
Wow.
15%. So we've actually had a situation where a borrower did that. I don't know who chipped in what or how it went, but
Wow.
they paid it off. We got an updated
Yep.
aging report and they were like at 14.87%. And they were off to the races. So
I love
again,
LOs. I mean, think outside the box. How do we solve this problem? How do we make
that's
this work? That
well,
is,
that was our suggestion to them. We told
oh, that
them,
was you. Good for
yeah.
you.
So
Well,
no, I'm
good.
gonna I'm gonna blow our own horn there
You
and
mean
say
you're going to take credit for something you actually did?
that
Good.
I actually
Yeah,
did, yes,
excellent. We
and
love
and
it.
that's something we really take a lot of pride in at Inter Island is finding creative ways forward. Not creative as in outside the rules,
No,
but
of
just
course.
proactively
Yep,
having the expertise to know if you can't go this way, let's see if you can go this way and trying
actually.
to get to the close. So yeah,
Absolutely. That's
no,
awesome.
that was our
So
idea.
we have some great comments thanking you for all this information, and we are so appreciative. It was great to see you. Thank you very much. And again, this will be posted on our YouTube site that is kept by Jason Bellevue for us. And he has been posting a lot of shows. So go there. You can put us on 1.5 speed and get it over with faster if you want. So do that. And if you
Just
want
do when I speak.
if you want the printout from Maureen, let
And
me know.
I put the link to the summary in the
They
chat.
can't see it. Yeah,
They can't.
that'd be great. They can't see it. So,
Okay, great.
yeah. So we'll get it to you. All right.
Okay,
Thank you,
yeah.
kids. Thank you, Maureen. Thank you, Kevin. We'll see you
Thank
next
you.
week.